In this, let's look at the second model, which is a straightforward formula-based model. Of course, a Nobel Prize winning model also in terms of finding out the price for the option. And probably when we deal with some of the case studies, I mean that's on a lighter side. When we deal with some of the case studies in the first book, what we will also see is a company in which two of these guys were on the board. It was the company with the biggest default, or probably the biggest failure in the history of finance. Probably a biggest disaster also. Probably 2 years after these guys got the Nobel Prize. Okay, I mean that was again uh, a big case study on risk management. Nothing to do with these first people, but it's more of an aggressive strategies in terms of executing. But today, even today, the options derivatives trading, options trading world is using only this formula itself, right? And the way how it has improvised over the binomial tree model is, in binomial tree we were trying out make the intervals as much narrower as possible to bring out the accuracy. What these people have come out with is, why as much narrow as possible, what about we make it continuous, because as much narrow as possible is nothing but making it continuous. So they made some assumptions behind the whole intervals being more and more continuous, and that's where they came out with, they try to observe some kind of patterns in the data, wherein they were saying that the stock prices will generally follow a log normal distribution. They have made some assumption. They have made an assumption that the stock prices will follow a log normal distribution, which means the stock returns will follow a normal distribution. Now, if I have to really check out whether Infosys returns were following a normal distribution or not, I can very well check out the skewness and kurtosis of the returns of Infosys. If they are very close to zero, I can say that they are following a normal distribution. Okay, the skewness is minus 2.95, which means they are not following a normal distribution, because there are some extremities that are there. Probably many stocks will follow, but Infosys was an exception in the last 1 year, because there were so many one day drops to almost a bigger extents. Almost probably, if you quickly see, one day stock prices falling that drastically are very odd instances. So probably if we see, no, 5 is a very small number as far as Infosys in there was a growth of 15% on one single day. I'll show you downs also. Almost 24% drop. Whenever they are announcing quarterly results, they are getting these kind of stock prices movements. They had very bad, I mean, at least until before Narayan Murthy stepped up, they had these kind of scenarios. The day they were announcing the results, the price comes down, and within after some days, the price mounts up. It was that volatile, right? So at least this was when they have announced their last quarter results, so after Murthy has come in. So probably the scenarios, if we see, there are so many big fluctuations, and because of those fluctuations, the skewness is coming out to negative. Otherwise, it will be generally zero itself. You remove those one or two odd cases, you will find more or less the skewness coming to zero itself. So, I mean, their original mechanism, the Black-Scholes, which means on any data you are applying the Black-Scholes formula, you have to be fully clear that the stock returns of it are following a normal distribution, or stock prices are following a log normal distribution. Otherwise, the Black-Scholes formula will not work. And to a large extent, our analysts, they blindly use the Black-Scholes formulas itself without seeing whether the distributions are following these kind of, whether the data is following these kind of distribution or not, because the formula which they have derived It's a lengthy formula, but the formula which they have derived will take all these assumptions into picture, because we won't get into the derivation part of that formula, right? Because it requires very much of integrations and all those kind of mathematical aspects. So the formula typically makes a lot of assumptions in terms of coming out with that simple, simple or lengthy, whatever we call that formula. There are so many assumptions that have gone into it, and probably even if I look at kurtosis, if I look at kurtosis, it's almost 54. It should be very close to zeros and all. So probably if I remove some of the outliers, let me just try removing these 1, 2, 3 extreme values to just check out if something gets improved for us. Okay, let me just try out with these three values deletion itself. You see, skewness is very close to zero, which means remove those one or two or three odd values, you will find the stock returns will generally follow a normal. Even one or two adjustments you do, even this also comes very much close into the normality loop itself, right? So whatever they have made as an assumption, typically the stock markets and currency markets to some extent, they follow this kind of a distribution, but other markets, they need not follow these kind of distribution at all. So this model may work only for these two kind of markets, but not for the other markets at all. Interest market, it will not work at all. The simple reason being, this model makes an assumption that the interest rates are constant, and the whole bond market